Hi, welcome back. This is Neil, and we're looking at Chapter 7, Foreign Currency Transactions and Hedging Foreign Exchange Risk. So we're not going to cover all of the chapter, but let's get through the specific points that you really need to know, the fundamentals, and then we can go forward from there. So let's have a look at some of the learning objectives, shall we? Here we have the learning objectives. And first, we want to provide an overview of the foreign exchange market, very briefly anyway. Explain how fluctuations in foreign exchange rates give rise to foreign exchange risk. Demonstrate the accounting for foreign currency transactions, well, just part of the accounting anyway, and describe how foreign currency forward contracts and foreign currency options can be used to hedge. Okay, there's a how, but at least have a basic idea of what's the difference between a forward contract and an option, and describe the concepts of cash flow hedges, fair value hedges. We're not going to go into great detail there, but just at least point out what's relevant in terms of what's acceptable and not acceptable under IFRS and GAAP, and what firms prefer to use. So we're going to look at that. We're also going to demonstrate the accounting for forward contracts, but we really won't have time to go into too much detail. We have a basic one. I've made a separate video for this, so we can look at basic debits and credits, how they are done. It's a little bit more complex, but let's see what we can do here. So we know the foreign exchange markets have been around for a long time. Between 1945 and 1973, most of the exchange rates around the world were fixed to the US dollar. And so when it's fixed, you don't have this forex accounting. You don't have these sudden devaluations of different currencies, which create risks for multinationals and therefore create gains or losses in terms of accounting for subsidiaries in foreign countries. But you know, since March 1973, most currencies were floated. And even as recent as 5 odd years ago, the yuan started to be floated with the Chinese currency started to be floated with the US currency. So there are different types of floats out there. The independent float, when the currency is allowed to move freely with little government intervention, and so that's happened to the Australian dollar. It was allowed to move fully freely against the US dollar during the 1980s. Late 80s, and it's been floating ever since. Or you can have a currency that is pegged to another currency like the Hong Kong dollar. It's always been between the range of 7.79 and 7.78, and it keeps on moving within that band, and for the foreseeable future the Hong Kong currency will still remain to be pegged to the US dollar. But we know that the yuan is it's not pegged to the US dollar, but there is a range within which the yuan is allowed to fluctuate in any one particular day. So it's not a peg and it's not fully freely floating, but it's sort of halfway in between. It's like a hybrid. Now we had the European monetary system, with the euro came in with 12 countries starting to use the single currency when it first started in existence, and now many more countries are using the euro as a single currency. That of course makes foreign exchange accounting much easier, especially if you're selling to multiple European countries. All right, who are the players in the foreign exchange markets? You have various different rates, and they're published on internet and newspapers, and they're reflected in direct quotes, indirect quotes, and it really depends on which currency you're talking about. So for example, the Australian to US dollar is kind of like an indirect quote. So the most common quote is how much a US dollar does it buy of the Australian dollar, but it's more common to say what percentage of a US dollar will one Australian dollar buy. So a direct quote would be that the US dollar buys 1.2 Australian dollars, but it's always been quoted in the other way, and that is 0.8 of a US dollar buys 1 Australian dollar. And so different depending on which currency pairs you're talking about. Some are quoted in direct ways, some are quoted in indirect ways. Okay, so now we want to get into some more terminology here, where we have forward contracts, and basically what you need for a forward contract is a spot rate, which is today's price, and a forward rate, which is today's price for purchasing a foreign currency transaction in the future, whether it's 1 month in the future, 2 months in the future, 3 months in the future. A very good example in the textbook, chapter 7, that's Dopich and Pereira textbook, the one that we're using. where they're actually, the first example is that the spot rate for the euro is 1.5 US dollars for 1 euro, and the 3-month forward rate is 1.485 US dollars for 3-month forward rate. So the spot rate is 1.5, but the forward rate is 1.485. And so we're going to talk about that in the example in another video. But for now, notice that there's always, in most cases, a difference between the spot rate and the forward rate, and it really reflects the future differences in the currency, or the differences in the interest rates between the two economies, the economic growth between the two economies, and other factors. For example, commodity prices, which affects a lot of Australia's exchange rate, or even the European Union, the growth of the different countries, which affects the strength of the euro. So often the forward rate may be at a premium to the spot rate, so therefore you can actually buy more currency in the future, or it may be at a discount, less than the spot rate, where it's actually less than the current rate today. Now, having said that there are forward rates that you can purchase, and you're thinking about, oh, let's choose the rate that is on our favor. Well, really, that is not the job of the multinational that's in the business, non-banking business or non-financing business. The job of the multinational is to leverage its expertise, whether it's making iPhones, whether it's providing services. It's a job of hedge funds, forex institutions, to actually speculate and make money on these differences in the spot rate and the forward markets. The focus of hedging for this chapter and for international accounting is to protect our risk in the future of a particular exchange rate, a particular currency just dropping out from underneath us, and we're waiting for cash to be received in 3 months on a sale we've given 3 months credit on, and suddenly the cash we receive is 20% less because suddenly the currency has devalued. So we want to enter into a forward contract to protect against the risk of that happening. Okay, now we have option contracts. And this is kind of, whereas a forward contract gives you both the upside and downside protection, an option contract gives you protection one way or the other, depending if it's a put or a call. There is an option to sell or an option to buy. And it's an option that you can just not exercise it at all. So then it just basically goes into the rubbish bin and not gets used at all. Or you exercise it and then you lock in that strike price at which the option has given you into the future. So basically a foreign currency option gives a right but not the obligation to trade foreign currency, trade in the future. And so the put option is an option to sell the foreign currency, a call option is an option to buy the foreign currency in the future. And the strike price is the rate at which the currency will be exchanged when the option is exercised. So the strike price is a particular contract feature in the option. Other features in the option is how many months the strike price is out. So have you bought a 90-day option or a 60-day option or a 6-month option, and a particular strike price for those dates in the future. So when we look at option contracts, I'm not going to go into full detail here, but just think about it as an instrument to protect future foreign exchange currency risk. The option premium is basically the cost of purchasing the option, and it's a function of the option's intrinsic value and time value. Okay, so the intrinsic value is immediate exercise. The gain, do you have a particular gain? So if it's in the money, you exercise it, you actually get a positive benefit from exercising it. But there's the time value, derived value, and currency value increase. So there are lots of factors that affect the option over time, and the most important factor is the time, and the other important factor is the currency that it is attached to, which could be affected by interest rates, country growth factors, as I mentioned earlier. So there are other courses that tell you how to actually value an option, but options in terms of an exchange contract, the difference between an option and a forward contract is the option that gives you a one-sided protection. Okay, so if you really know that it's going to go a currency is going to go one way, but you're not sure if it's going to go fast or slow, then an option might be in your favor over and above a forward contract. A forward contract will lock you into a strike price in the future, okay, no matter which way the exchange rate goes. Foreign currency transactions. Let's have a look. Again, we're still looking at option contracts, and we want to have exposure to foreign exchange risk. So for an export sale, a sale to a foreign currency, so you're selling into Europe, and the example in the textbook talks about $1 million sale, and you're going to get paid in 3 months' time. And the example in the book is the conversion of €1 to 1.5 US. So 1 million euro sale gives you in the future $1.5 million if the exchange rate is still 1.5 to 1, okay, but we know the exchange rate changes over time. Or the example that we don't go into the book in directly is import purchase. That means you're purchasing from China and you're working with the client, or your Walmart or your Gap. You're a big company, so you have a lot of power, and so you can negotiate with the supplier to give you terms. That means you get delivery of the product today, but you don't have to pay until three months later. So maybe in 3 months' time, when you get to pay, maybe if the yuan appreciates during that time and your contract is in yuan, maybe you'll have to pay more than what you would have if you paid straight away. So you've got to be careful here. It's always nice to get credit. It's always nice to get credit, but you must consider, is that credit in a currency that's likely to appreciate in the future? If that is the case, then it might be better to pay cash today, or enter into number one, an option contract, or number two, a forward contract. So you can lock in a future strike price. You can lock in the forward contract rate, which is today's forward contract rate for the future when you actually pay the supplier. So we have export sales that we need to consider, which is all about protecting your accounts receivable asset. And we have import purchase transactions, which is about protecting your accounts payable account. And so foreign exchange risk is all about that. It's all, have an option contract or forward contract is about protecting yourself from variations in the currency between when you actually make delivery, or when you make a sale, when you receive delivery, and when you pay cash, or when you receive the cash. And it's that time in between, that uncertainty where the foreign exchange could change, that you want to protect your company from any adverse changes in that foreign exchange risk. Now, you cannot protect it 100%, but you can protect a lot of that variation by using a forward contract or an option contract. So let's have an example, shall we? It's always good to have examples. So we have a basic foreign currency transaction here. Joe Incorporated, it's a US company, makes a sale and ships goods to Joe's SA, a Mexican customer. So we've got a US company shipping goods to a US customer. So they made a sale. So does that affect accounts receivable or accounts payable? You've made a sale to a foreign country. That's accounts receivable, because you've created an asset for the receipt of a future payment. And what is that asset? A sales price is $100 US, and Joe allows Joe's, the Mexican company, to pay in 30 days. You're given 30 days credit. Okay, so the big question is, you'd like to receive $100,000 US in 30 days time if there's no exchange rate change, but what happens if the current exchange rate is 10 cents per 1 peso, and in the future it goes to 11 cents, or it goes to 9 cents? Which one of those are good, which are bad? Let's explore this, shall we? So Joe plans to receive 1 million pesos, that is $100,000 US, okay, divided by the 10 cent exchange rate. So let's have a look what the exchange rate means. 1 peso is worth 10 cents. Now, if this goes up to 11 cents, that means the peso has appreciated. If this goes down to 9 cents, then the peso has depreciated. Okay, now which one is good or bad for Joe? Interesting here. So let's have a look at what that means. Joe has a foreign exchange risk exposure because he may receive less than 100,000 US dollars. If the peso decreases such that 30 days, the exchange rate is 0.09 per peso. Oh, that's interesting. It's gone down to, the peso is now only worth 9 cents, not 10 cents. So now Joe is only going to receive 90,000 US dollars in 30 days time. He has actually lost $10,000 due to the exchange rate fluctuation. So we want to account for that. Now there are two options. There's the one transaction perspective where we actually do everything in one transaction, but that's not allowed under IFRS or US GAAP. So basically we're going to skip that. So we're going to use the two transaction perspective. Two transactions. We've got a sale, collection. They are two different transactions. A sale was made today and you've got accounts receivable 100,000 US dollars. But in 30 days time, because the peso has depreciated, you're only going to receive 90,000 US dollars. So you've got two transactions we need to record. The sale is based on the current exchange rate, and the difference is considered between the sale and collection. The collection is that for a different amount. That happens in 30 days time. And you're going to account for that difference in terms of foreign exchange gain or a foreign exchange loss. So let's have a look at what this looks like in debits and credits. So we have an export sale, example 1. February 1, 2012, makes a sale, ships to Mexican customer, sales price 100,000 US dollars. Joe will receive 1 million pesos, which will be worth 100,000 US dollars in 30 days time. Joe agrees to pay pesos in March the 2nd, 2012. 1 month later, assume a spot rate of February in 2011 is 10 cents per peso. Remember, the spot rate is basically the current exchange rate. So there we have accounts receivable and sales. You know that, all right? We've got accounts receivable, debit, sales, credit. That's recording the sales. What about the receipt? Well, we're only going to receive 90,000 pesos in cash. So cash gets a debit of 90,000. You've got a foreign exchange loss of 10,000, and then you've got accounts receivable of 100,000. So you've got to close out the accounts receivable. You didn't receive all of that 100,000 in cash. The difference is a foreign exchange loss. If only we had have known, we could have written a forward contract or an option to protect against this loss, right? Let's move on to example 2. And in this example, we want to make it a little bit more complicated, because in the example 1 we had a cash sale, then we had accounts receivable sale, then we had a cash collection, or 1 month apart. Now we've got accounts receivable sale 3 months terms at 1st of December, and we've got a cash collection at the 2nd of March, which is 3 months later. But in between we have a reporting date, that is 31st of December. It's a reporting date for all US companies. So we have to do 1, 2, 3. We have to do 3 different sets of entries recording different parts as we go. So let's go into it, shall we? And we'll take it slowly. We've got example 2. Joe makes sales and ships goods on December 1st. It's a credit sale, and remember, it's 3 months. The spot rate of December 1st is 11 cents per peso. Interesting, at the end of the month, when the balance sheet closing date, we have 10.5 cents per peso. That means the peso has appreciated or depreciated. Peso now buys less US dollars than what it did a month earlier. So basically the peso has depreciated. So Joe at the year end will need to do the following. Let me repeat. He will receive 1 million pesos, which will be worth $110,000. That's what he's hoping. That's the accounts receivable. And there's the sales. That's at December 1st. But at the end of December, the peso has actually depreciated from 11 cents to 10.5 cents, that each peso can buy. So now we've got a foreign exchange loss that we're booking and accounts receivable adjustment of $5,000. Interesting. This is a new transaction that is only undertaken for the purposes of rendering the balance sheet and income statement for the end of the reporting period. Cash has not been received yet. So let's fast forward 2 more months to March 2nd, 2011. Now we receive our cash. We have accounts receivable 105,000 and we've got a foreign exchange loss of 15,000. What does that mean? This is the difference because the peso at the end of December was 10.5 cents US that each peso purchased. Now it only purchases 9 cents. It's gone down 1.5 cents US dollar for every peso in that time. And because the contract is 1,000,000 pesos, there's a loss of 15,000 US dollars against accounts receivable 105,000 US dollars. So we're closing out there. So we actually report a foreign exchange loss of $5,000 at the end of the balance sheet period. That is at the end of the reporting period, that is December 31st. Now 2 months later, we're losing a further $15,000. So our total foreign exchange loss is $5,000 plus $15,000. You've got a total of $20,000. So there's our basic problem. When we start to delay the receipt of the cash from the date of the transaction or the contract, that forces one party to actually buy money in the future or sell money in the future through accounts receivable or accounts payable, then we have this risk of foreign exchange. Especially if you're using a foreign currency, you've got a risk that the currency will appreciate, the currency will depreciate. And so, is there some way that we can hedge this risk? Well, yes, there is. There are 2 ways. There's a forward contract, which is a contract to buy or sell foreign currency at a future date, or there's a foreign currency option where you can a right to buy or sell a foreign currency for a period of time. This is what we mean by hedging. So remember, Joe lost 20,000 US dollars because the peso went from being able to purchase 11 cents for each peso down to 9 cents per peso over the 3-month period. $20,000 US loss on a $1 million peso contract. You'd want to hedge against that, wouldn't you? Maybe if it went the other way, you're thinking, no, we don't want to hedge. We want to make as much money as possible, even if it's through speculation. But that's not the game we're playing here. The game we're playing here is to minimize our foreign currency risk. And we do that by having a forward contract or an option. Let's have a look at an example here. We need to hedge a risk on an export sale. Example number 1. Previously, Joe lost how much? $20,000 without hedging as the peso fell from 11 cents down to 9 cents. The loss was the difference of that 2 US cents per dollar, US dollars, 0.2 US dollars, 2 cents, times 1 million pesos. Joe could have purchased a foreign currency forward contract in December the 1st. So what were the forward contracts on offer? Joe could have agreed to sell the pesos for 10.5 cents in March 2nd, 2011. That's better than what it turned out to be, 9 cents. That's the spot rate. But who can predict the future? And again, Joe is not in the business of speculating, so let's try and hedge and protect any upside or downside in the changes in foreign exchange. In this case, Joe would have collected $105,000 rather than $90,000. Instead of a $20,000 foreign exchange loss, Joe would have paid a $5,000 premium on the forward contract. Now that's how you hedge a foreign exchange risk. Now, of course, if the peso went up to 13 cents, then Joe would have missed out on that foreign exchange gain in the future. Now, you may think, well, maybe the opportunity of that happening is higher, so we may want to speculate. But as I said earlier, the strategy of most multinationals is not to speculate on foreign exchange changes. The strategy should be focusing on protecting of the risk in that variance, whether that's positive benefit for you or a loss for you. So we can have a look at the example 2, a hedging risk on an export sale. Previously, Joe lost $20,000 without hedging as the peso fell from 11 cents to 9 cents, as I said earlier. The loss was this amount in pesos. Joe could have purchased a foreign currency option in December the 1st, 2010, and the option premium is $4,000. And so this option would have allowed Joe to actually receive 1 million pesos at the exchange rate of, hopefully it's 11 cents. And the cost of that option is $4,000. It's just a flat fee, $4,000. Remember, the forward contract allowed Joe to buy pesos, buy US dollars from that 1 million pesos at 0.105, that is 10.5 cents. So Joe is losing 0.5 cents under the forward contract, which accounts to $5,000 in terms of the net loss. Under the option contract, there's that premium you pay for the option right at the beginning, $4,000, that allows Joe to lock in this 11 cents in March 2nd, 2011. Joe would have collected $110,000 rather than $90,000, and after paying the $4,000 on the option, his net cost will be $4,000. So in other words, he would have saved $16,000 of that it lost, $20,000 minus that $4,000 option. So let's have a look at cash flow versus fair value hedging. Now the point we want to make here is that IFRS and GAAP report a cash flow hedge different from a fair value hedge. And so companies, do they have an incentive to do it one way or another way? Yes, they do. They have an incentive to actually report a cash flow hedge versus a fair value hedge. Make a note of that. Most companies have an incentive to actually report using a cash flow hedging approach. So a cash flow hedge, gains and losses are recorded as comprehensive income, like a pseudo equity account. But under a fair value hedge, gains and losses are recognized immediately in net income. So in terms of a fair value hedge, once you've committed to that, you are giving up more control over your net income. And if you're like thinking about Wall Street as your number one shareholder, and you base of shareholders, and you're promising a certain amount of earnings per share to the various analysts, you want to have as much control over that net income that you want to report as possible. And to have more control means that you're going to focus on a cash flow hedge accounting rather than a fair value hedge accounting, which may knock your net income around from quarter to quarter. Of course, in the end, there's no difference in what's in a cash account, but the difference gets rendered in your income statement at different periods. The complexity of this accounting occurs when you have to report mid-time between making the sale and actually executing on the cash account of the transaction. In this case, it happened at December 31st, between December the 1st and March. So that's why hedge accounting becomes a bit more complicated, because we're trying to, at the end of the balance sheet date, we're accounting for transactions that are halfway between the actual sale and the actual cash being received. Makes it a bit more complicated. We don't have to know all of those debits and credits, but just really understand the basic one that happens at the sale time and the basic one that happens at the cash receiving, and how forward contracts would be reflected at the sale and at the cash receivable time. That's what we're going to be focusing on in this class. Thank you very much. That's the end of hedge accounting. Remember, it's all about focusing on the strategic value added that a multinational is engaged in. Most multinationals are not engaged in speculative activity, so therefore we need to use forward contracts or hedge or options to protect against any speculative risk that arises by having transactions in foreign currencies. Catch you in the next session. See you in the classroom. Thank you very much.